Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we talking about? Well, for the methodology in action, I want to show that markets are markets and talk a little bit about free rolling, and that's the money and position management I use in order to catch a swing trade and, I hate to use the word hope, but hopefully hang on for a long, long time. And that'll make sense in just 1 second. I want to show that markets are markets by showing a trade in crypto. I'm going to continue my minor trade series on the wisdom of Jesse Livermore. And housekeeping, I do take requests. There's something you want me to cover. As you probably saw a couple of weeks back, I took a pause from the Livermore presentations and talked about my daily routine because one of you guys was very curious about that. So leave a comment on Facebook, or you can email me at davelandry.com/contact, and I'll be happy to respond. And I would welcome some fodder for a show. If you need the slides for this presentation and all the other slides combined, go to davelandry.com/StockCharts. If you would like to join me weekly, and these shows are still live, so you can bring your questions and your favorite stock picks, you can go to davelandry.com/webinar. There's my Twitter information. You can reach me on YouTube at @DaveLandry. I would appreciate it if you subscribe and like while there. By the way, if you like this video, well, I guess it's too long. Maybe it's too early to know, but if you like what you're seeing here in general, make sure you like this video and feel free to leave a comment below. I read all comments and I answer when necessary. All right, let's talk about the mystery charts and the methodology in action. No mystery chart this week. There's no setups lately. There hasn't been a whole lot of setups lately. We had one or two earlier this week, but neither triggered. The bottom line is markets are markets, and the core methodology works in all markets. In fact, sometimes inefficient markets like crypto, the core methodology, which is swing to intermediate term trend following, can work quite well. Now, the secret to longer term success when it comes to trading, as I often preach, is free rolling, and that's when you get a swing trade off and then you're able to trail a stop on a remainder. So there's the orders down there. I'm not betting the form in crypto, and neither should you, by the way. Notice we had a nice Landry light. We had a little bit of a pullback in here. Now, this isn't a 30 EMA pullback, a Landry light pullback, but I figured it had pulled back enough to make a trade worthwhile. Entry was there, initial profit target was there, and about 3 or 4 weeks ago I wrote the next big thing and question mark. Now, I had 2 or 3 other trades in there that stopped out for a gain overall, but we weren't able to trail longer term. But this one, I'm still in it, and we'll just keep following up on it. Now, remember, once the initial profit target is hit, we bring our stop up to break even, and that's the same place that we bought the stock, obviously, and then we'll trail that stop higher and see how it shakes out. So I'll continue to follow up with this. And here's the thing, if something turns into the next big thing through the free rolling, you're able to be there. And we had, I forget the amount, it probably goes up 100% every webinar, but it was several 100% move in a coal stock, and it was just a setup that we had as a swing trade, and we got half of our profits out at the initial profit target. We took them there, and then we trailed the stop higher and stayed with it for a year and a half or more. All right, let's continue our discussion on Jesse Livermore. Just real quick, 90% or most of what I'm drawing from comes from Reminiscence of a Stock Operator. I will use the biography to fill in some color commentary on Mr. Livermore, and eventually I'm also going to pull a little bit from Livermore's book, How to Trade in Stocks. The biography is really good. All 3 of these books are really good. I would say read this one first, and then read the biography, and then pick up How to Trade Stocks. You can find those on my website at davelandry.com/books-2-read. I'll put a link in post. All right, when we last left off, Livermore had a hunch to short UP while on vacations. That back then the ticker was UP for Union Pacific. And then the next day, San Francisco had a horrible earthquake. Now, he seemed a little clairvoyant at doing this, but he also had some justification. Momentum was slowed. Everybody in the world was bullish. And he figured that because the minimum was slowing and then everybody just wanted to buy any old thing, as he said, that he thought it was topping out. But he was still top picking nonetheless when he did this. The street paid no attention to the earthquake the first day or two. They'll tell you that it is because the first dispatches were not so alarming, but I think it was because it took so long to change the point of view of the public toward the securities markets. Even the professional traders, for the most part, were slow and short-sighted. So at this point in time, there was a raging bull market happening. And in a bull market, the market will ignore bad news. I'm going to flesh out a little bit of that in just one second. In a bear market, just the opposite. The tape doesn't lie, does it? It doesn't always tell the truth on the instant, I said. So you have to watch for what actually happens in the market. The news is one thing, and everybody, especially in this day and age, everybody has the same exact news at the same exact time. It's not the news in and of itself, it's a reaction from the market. So again, the street paid no attention to the earthquake for the first day or two, and then on day 3, he made $250,000 on this trade. So the point that I want to point out here is don't worry if there's bad news until the market tells you to. So I think the pandemic makes a fantastic example. I remember when the pandemic was declared and the market was in a bit of a what me worry mode, it went on to make all-time highs. Now you could argue that it didn't do so with a tremendous amount of vigor, but it made new highs nonetheless. And then, ruh-roh, the market really began to pay attention and it began to implode. Now, as a trader, I didn't say, oh, there's a pandemic, I better rush out of the market or cancel all my positions, get out of everything, or whatever, because the market was continuing to go higher. But what I did was make a mental note to think, okay, as long as we're above the price where the bad news hit, it's kind of a don't worry, be happy situation. But when that close gets taken out, that's when you need to become concerned. Now, this is kind of a big picture news reversal. I worked with Connors many years ago doing some consulting with him and did a little programming and system design and such. And one of the things that he talked about was big picture news reversals, and I'll explain that in one second. So we did have signals to sell. We had a bow tie sell signal on the daily when the market began to crack in earnest. Now, we also had a TFM 10% sell signal that triggered. And this actually kind of surprised me a little bit because it triggered so quickly. And I kind of thought of this as a longer term, simple, but a little bit slower system to get you out of the market. So avoid trying to get caught up in too much whipsaw. But it did trigger fairly quickly. In fact, around the same time, or right before I think the bow tie triggered, we got this weekly major signal. So this was a bit of a concern. Now, the pandemic was declared, and again, the market kind of blew it off for a while and then imploded. And I just Googled when the pandemic was declared over, and it was actually just a couple of weeks ago that the pandemic was over. But you could see that the market rallied significantly from these lows, and even on a net basis from the lows of the pandemic to where we are now. Now, I do remember I did a presentation in April, somewhere around here, because there was blood in the streets, but the market had already started going up. There's an old Wall Street adage you want to buy when there's blood in the streets. And there's some truth to that, but again, you don't want to try to time the market off the news. You want to wait to see what the market actually does. As a trend follower, you wait for the market to trend one way or the other, or make a trend transition like it did in the pandemic. Then you look to get in. In the fall of 2011, I was speaking in Dallas, and somebody raised their hand and asked, what's going to happen to Apple after Mr. Jobs dies? He was diagnosed with pancreatic cancer. And I said, well, pay attention to Apple when he does pass, unfortunately, and see if that close from the day before gets taken out. And again, this is something I learned from Larry Connors' big picture news reversals. And you could see that there was a very muted reaction to his death, and it's probably already baked in the cake. It's probably why. But then notice that Apple did rally. So anything below the pre-death day, or in this case it was a death day because he died after the close, is okay. And anything below it means that Apple is concerned about it. Now, I did kind of take off and go straight up. Depends on your trading time frame. Maybe you could have made a little on that. But you can see longer term, Apple was able to survive over the next several months. So it's not the news in and of itself, it's a reaction to the news. So again, anything above the day before he died is okay. Anything below, you need to be concerned that maybe Apple is taking it very seriously. Now, Livermore, after he made all his money shorting, he then began buying UP. There was a longer-term trend in place. It's almost like he was playing a pullback here, something like I like to do. And he had this person in the office that kept trying to save him from being long the stock. And he said, you can't expect a miracle to save you every time you plunge into a stock. Get out while you still have a chance, he said. It's a crime to be long of that stock at this level, when these high binders are shoveling it out by the ton. The tape says they're buying it. I insisted. Larry, I got heart disease when your orders began to come in. He was under a pen name for this book. For the love of Mike, don't be a sucker. Get out right away. It's liable to bust wide open any minute. I've done my duty. Goodbye. And he hung up. So this guy was trying to warn him that there was some inside selling going on, and he was being fed the shares as he bought more and more of UP. Now, he allowed himself to get shaken out of the stock. All I had to go by in my purchases of UP was my years of studying the behavior of stocks and the perception of certain symptoms, which experience had taught me usually accompanied a substantial rise. I don't know what happened to me, but I supposed I must have concluded that my tape reading told me the stock was being absorbed simply because very clear manipulation by the insiders made the tape tell a story that wasn't true. So he began to doubt himself because this guy was so sure that he was being fed the stock, so to speak, that he decided that, well, maybe I should get out. Possibly I was impressed by the pains Ed Harding took to stop me from making what he was so sure would be a colossal mistake on my part. If Ed Harding hadn't tried to save me money, I'd have made a killing. But he did me a great service, for it was the lesson of that episode that I firmly believe completed my education as a trader. It was not that all I needed to learn was not to take tips, but follow my own inclination. It was that I gained confidence in myself, and I was able finally to shake off the old method of trading. That Saratoga experience was my last haphazard hit or miss operation. He was on vacation in Saratoga when he did all this UP trading. From then on, I began to think of basic additions instead of individual stocks. I promoted myself to a higher grade in the hard school of speculation. It was a long and difficult step to take. So in this book written under a pen name, Livermore is very philosophical. And even when he loses a lot of money or has a tremendous opportunity costs lost, he basically tells you that it was a good lesson, and even though it was an expensive lesson, it paid for itself. I added to my list of assets, my list of don'ts assets is what he calls it, his list of don't assets. In a bear market, all stocks go down. In a bull market, they go up. I don't mean, of course, that in a bear market caused by war, ammunition shares do not go up. I speak in a general sense. So remember that as a general statement, in a bull market, most all stocks go up. In a bear market, most all stocks go down. That his point is sometimes certain stocks will rise, but in general, most go down. Now, shifting gears, getting into chapter 7, Livermore talks about his buying and selling of stocks. And he talked about the fact that he would scale into stocks. Now, I actually believe in putting on the whole position at one time. I think as a small private trader, that's the way to trade because your trades aren't going to move the market if you're in fairly liquid stocks, of course, that much. And you're able to take partial profits quickly should the market move at least a little in your favor and you're able to capture that initial profit target. Now, again, Livermore believed in scaling in, but he was also trading in a much larger size. People don't seem to grasp easily the fundamentals of stock trading. I have often said that to buy on a rising market is the most comfortable way of buying stocks. As a trend follower, you will pay up for stocks. You're not a bottom picker, and that's a quick way to end up in a lot of trouble. Now, the point is not so much to buy as cheap as possible or go shorts at top prices, but to buy or sell at the right time. When I am bearish and I sell a stock, each sale must be at a lower level than the previous sale. When I am buying, the reverse is true. I must buy on a rising scale. I don't buy long on a scale down. I buy on a scale up. Now, paying up means that there is demand. So he takes a position and he does not add to that position unless the stock begins to go up. Now, Livermore tells a story of Deacon White. Now, there was a person who told Mr. White a stock tip, and the reason he told Mr. White was that Mr. White would pay for good tips and give the person some shares and play along. And Deacon White began to sell the stock. He sold 10,000 shares, and then he sold another 10,000 shares. So he did just the opposite of what the tip was initially. And the reason he was doing that was he wanted to see if somebody truly was buying. He wanted to see how easily he could sell those shares at what price he got. And that told him that the stock was being accumulated. It reminds me of a story from Damon Pavlotas, who is Linda Ratsky's husband. I hope I didn't butcher his last name. And one time when he was a futures broker, I don't know if he still is or not, but some big trader came in, somebody from like Market Wizards or some sort of fame like that, and wanted to buy 400 S&P contracts at a certain price. And then Damon got him the price like immediately, and the guy says, okay, we need to unload those. And the reason he wanted to unload them was he got them too easy. The market was willing to give him his position. Let's say a stock's trading at $20 a share, you put in a market order, you get your fill back at like 20, 25, or maybe even like 20.50, but then the stock goes to 21, 22, 23. So sometimes those worst fills are your best trades. I'll do things like I'll put in an S&G order on an options position for just a really low price. And sometimes I'll actually get the option. It's like, oh crap, they gave me the option. So that means it was a little too easy. It means that somebody was looking to unload this on me or whoever else, obviously. So it's okay to pay up for a stock is the whole point that Livermore was making, and I'm trying to make too. Now, one thing they pointed out is that big operators have to sell or buy when they can, not necessarily when they want to. So as a small private trader, you could take advantage of sometimes the predicament of these players, and sometimes you can play along with them. For instance, let's say there is an opening gap down in a stock that's in a really strong trend, and this is something I talk about quite often, is trading those opening gap reversals. And it doesn't happen that often where it sets up just right. You have to have a big cap stock. It has to be in a really good trend and big cap, so you have a lot of institutional support. And ideally set up with something like a TKO or in the midst of a pullback. And then you go in on the gap and you look to play that reversal back in the direction of the longer term trend. And so what happens there is there might be some big institution or operator, as they used to call them, who wants to buy the stock, who doesn't own enough of it or any. And when it gaps down, they use that as an opportunity to get into the stock. Some sort of little news event shakes people out, or I should say the reaction to the news event, and then they come in and swoop up some stock. And that could actually be something to your advantage. Now, Deacon talked about scaling in, as did Livermore. And again, I disagree with that as far as a small private trader. Yes, if you're a big institution and you want to accumulate a large position, thousands and thousands of shares, then by all means, buy some, see what happens, buy some more, and just keep on buying if you're getting your price. And as Livermore said, he would always buy at higher and higher levels. So if he bought in, let's say he started buying 1,000 shares and the stocks began to drop, he would probably stop out of the stock and not buy more thinking he's getting a bargain. So I disagree with scaling in, but I understand if you're an institution or a large trader, you might have to scale in to a position. Well, that's all my time for this week. If you have any questions, davelandry.com/contact. If you want the slides from this presentation, all the other slides combined, along with all three of my books in PDF format, limited access to the members area, and a bunch of other good stuff, go to davelandry.com/StockCharts. And again, you can join me every week at davelandry.com/webinar for Dave Landry's The Week and Charts. I want to thank everyone for watching, and may the trend be with you.